Hey guys, Tim Hissam here. Hey, I want to bring you guys some information on things you need to look at in your organization from a data and numbers standpoint. Um, I think it's so important that we understand where our money's at, where it's coming from, and why. You can't manage your business if you don't understand your money, right? So I've put together a handful of dashboards and like pipelines and charts for you that you can use if you're a startup to get you going in the right direction. Now, there's plenty of MRP systems out there, ERP systems out there that you can use, and sales dashboards like Salesforce and stuff like that that are super useful and helpful. But if you're looking for a low budget or no budget example to run your business, this might be a good place for you to start. Secondly, if you're already you own an existing business or run an established business, what I want you to get out of this message today really is to make sure that you've checked all the boxes that I cover. I mean, I hope that you've already doing all this stuff I'm about to tell you, but the purpose of this again today is to just kind of bring awareness to a couple categories that potentially could be overlooked. Okay, so let's dive right in. The first area I love to focus on in an organization is the income statement. If you don't have an income statement, pro forma, you don't understand where your business is going, how the hell can you manage it, right? So I really want you to make sure that you've got a good pro forma statement that projects what you think the rest of the year should look like or what a year should look like. And you can compare, hey, how did I do versus what I thought I was going to do, right? So this will help you also finish up your financials in a more timely manner because you're going to know all your numbers all the time, right? So the big areas that we like to cover in the income statement is the revenue and the cost of sale. So the revenue is where's my money coming in? Where is my money? Whim, baby, whim. Right, Judge Graham? And then the cost of sale is, hey, what does it take to make that product? So me being in manufacturing, it takes materials, it takes direct labor. So that's the people putting stuff together. My indirect labor is the people that are kind of supporting my manufacturing laborers. Contractors would be people that are doing outside service. Then you got supplies, freight, and there's many other buckets that you can fill once you get below the G&A and sales expense and stuff like that. This is, again, just a template for you to use. If you're an existing business, one thing I want you to consider is doing something we did. So we brought in a guy that basically went behind our databases and made a bunch of custom reports and created a bunch of awesome dashboards that were very specific and unique to my business. And it didn't cost much, and they got it done pretty quickly. So you might want to consider, like, hey, if your ERP system's not giving you what you need, what can you have that's tailored specifically to what you need? And it might be just a quick one-time expense, and you're off and running, right? So we're going to dive into some of these things, but the important thing to know here is that there's only 100 pennies in a dollar, right? So that's why when you kick over here, it says 100%, right? I've allocated what I want my target to be for each one of these. So I want a net profit of 31%, and I want my gross profit to be, was that 57%? So I've associated that whenever $1 comes in, it better hit 57 of them, better go into gross profit. And after I've paid all my expenses, I better have 31 cents left for every dollar that comes in. It's kind of the philosophy that we have on how we run it, right? So the first area I want to jump into quickly is my sales. This creates revenue, right? Where is my money? Man, my life changed after I started asking myself, where is my money? I started getting pissed off because I didn't know where my money was. And I found that my money was not where it needed to be because I wasn't managing it properly, meaning I wasn't holding my sales team accountable enough, right? So in generic, here we go. I'm going to talk to you about a few things. You need to have a sales pipeline in order to forecast what you think your sales number is going to be from an actual to forecast standpoint, right? So to forecast, again, you better have a sales pipeline. Okay, so in this scenario, I put a customer, and then you've got different pull downs, so existing, referral, and new and organic. So these are just ways that you can kind of filter out maybe what type of sale this is. So your approach might be different, right? If it's a referral, you want to make sure you jump on that right away. You want to make sure that you tell the guy that's referred it, hey, thank you, and all that mess. If it's an existing account, you know that you might have a little bit higher close rate. And if it's new and organic, you might want to treat it a little bit differently. So it just kind of helps you see where are your sales pipeline and your sales coming from. Are they all existing? Are they all referral? Are they all organic? And maybe you have an initiative to grow your business by 10% in organic, and you want to get 50% in referral and the rest in existing. So you gotta figure out where you want the source of your sale to come from. Then you got to put your projected value. So if you've got a customer and it's an existing account, you projected this deal to be $10,000, you got to now know where it's at in the sales cycle, right? So the first part of a sales cycle is, hey, the project is identified. You found something, you found a customer, you found an opportunity, but you haven't actually engaged with that customer, right? But you know they are a qualified buyer, right? So I put in 10% for all projected projects identified. I put in 20% for something that you got in quote. So hey, you'd be like, I found a deal. You made contact. He's like, cool, yeah, quoted. You have to just basically justify these numbers based on your history. So if you've got history, go back and tie it into it. Be like, hey, every time I identify an account, I close 1%, 5%, 10%, 20%, whatever that is. Pop that in there as your standard. Once you move it into quote, what's your close rate? If you move something into quoting, is it 20% of the time you close it? Again, use history to determine what that number needs to be. So adjust that percentage. Once you've made your pitch, is it a 50-50 sale? Is it a 100% sale? Is it a 90% sale? For me, if it's an existing customer, I close 80%. If it's a new customer, I close right about 40 to 50%. So I want to get as much of the high volume, high percentage, high probability stuff that I can possibly get in there, because it costs almost the same amount of money to go through the whole sales process. So how do you spend the least amount of money in sales to generate the biggest return, right? Just know your numbers. And then once you get to win and loss, obviously it's 100% or zero. So you can see how it automatically kicks over your pipeline value based on which stage it's at. Another category you might want to look at is like, hey, is this recurring revenue or is this a one-time buy? Like, is the customer just going to buy and leave, or is the customer just going to buy and stay, right? You might already know that, and that'll help with some customer attrition and planning, which is nice. If you've got multiple sales reps, you can pop them in here, and I'll show you where that kicks out later. But then you can put too, where are these funds at, right? So you've got all these projects identified and in quote, but they're all for May, right? So you're got it kind of dialed in for May. So you would hope that those would then turn into pitched in one within the month or two, or whatever your sales cycle looks like, right? So you start to project out where your business is at. We're going to highlight this one right here, okay? So this is what's going to kick out customer number 26. It's an existing account, but you can see that $50,000 projected value, and they won it. You won the business. Cool, right? Like, that's a big deal. The average one of your accounts is like $10,000 to $15,000. Some are 20, but this guy now is 23.97% of your business. So what happens if he goes belly up and can't pay you? Are you out of business? So we're going to talk about customer concentration, right? But this is the template that I use in this scenario that will help you kind of manage your business from a sales aspect, okay? And then down here, you're going to have your actuals and forecasts and what your difference might be to help you, again, plan. So you'll see green tab, and there's another green tab here. That's what they're associated with. Blue's blue, yellow, yellow, green, green. Got it? Good. So now that you got your sales dashboard, there's 4 key areas that I'd hope you're looking at. You need to look at them, okay? So customer concentration, again, bam, that came right off of that database right there. So with that, it's telling you you've got a high-risk customer. So you need to make sure that they've got money and they're going to pay you, right? So keep an eye on that one. They could choke your cash flow out and put you out of business just as quick as they got you in, man. So a big customer can win for you, and a big customer can take everything from you, right? And then also you got to be considering, if you're positioning your business to sell it, not having too many high concentration customers, because they can basically erode your valuation a little bit, right? It's just too risky. So that's where that customer concentration came in. And then we talked about revenue attrition, right? So it's like, hey, this might be a customer attrition or revenue attrition. In my business, I look at revenue. So where am I at? Am I baseline $500,000 a month? up and down, and I don't really care which customers contributed to it in this particular model. And then I drill down into each of my customers, and they have their own specific customer attrition. But some of your businesses that you might be running are one-time buy customers. You might not keep them, but you need to look at your revenue. Are you maintaining a solid flow of attrition, right? So if you've got long-term customers, you definitely want to measure them individually, but have it all roll up, okay? So attrition and concentration, I think, are two things that a lot of companies overlook, and that's why I started with them first. And then the second part of all this is the sales pipeline. This is like everything to me. Like, you don't have a business unless you've got revenue, and you can't get revenue unless you know where you're going to go get it from. And if you don't know where you're going to get it from, you're done, right? So I put two scenarios in here. I have Jim and Ray as your two sales guys there, and we've got these broken up as one-time buys and reoccurring revenue, and it shows you where they're at in their models. But basically what you're trying to do here is go, in my pipeline, I need to hit $30,000 a month to make sure that I hit all my numbers and make a profit that I'm happy with. In order to do that, I need to have X amount of dollars in quote, X amount of dollars being pitched, and getting that closed as quick as possible, and getting those orders booked in the system as fast as humanly possible, so you can start collecting your AR and get them out the door, right? So this is just a real quick model to give you, that's coming off of the sales pipeline, that's going to give you an idea of where your pipeline is standing. So you can see right here, you got a ton of stuff in quote and a little bit being pitched. He needs to be more like Jim, most likely, where he's got a good fair amount in quote, but he's also got quite a bit in pitched. So between the two guys in the pitch department, they're pitching, $32,000. But if you only got a 50% win rate, that's not likely to get all your numbers. But you have the recurring over here too, that you have 35 and 24. So it's kind of helping you look at those two numbers. So as long as all that adds up to be based on your percentages over your 30 grand, you should be in good shape, right? So the other part that kicks off is your the forecast. So yeah, good, great. You did your forecast, you projected all this stuff, and you've got some data from your salespeople. Cool. What did you book, right? You planned on getting 25. What did you actually do? So in this case, you forecasted 22, 22, 22 across the board, and the actual was 25, 43, and then 71. Remember, we had that huge month. So this could disrupt your cash flow. So you got to keep an eye on that, right? So keep an eye on that heavy concentration customer. And don't just assume because it's big, it's a good deal, that you're going to make money on it and that they're going to pay you, right? So you got to be very honest with yourself there. The next part is on the income statement that I like to look at is how well we're performing from an operational standpoint. So revenue, what did we bring? Did my salespeople bring in that revenue so that I can get it out the door and get it closed, right? So you've created the AR, you've created that revenue. That's great. Now how much of it did it cost you to make it? What did you keep from the resources that it cost to make it, right? Don't be paying your contractors too much money and now you can't get your deal done. There's no money left over. It's like, yeah, I'm making money after I've paid the contractors, but now there's not enough money left over for me, right? Where is my money? Ask yourself, where is my money? It's that important. If you can't put the model together to show your revenue, make sure you're making a certain percentage after you've paid your contractors and workers and materials and all that garbage, and you've got your G&A, now you can get to work, right? There you go, net income. So the last piece about this that I'm going to talk about real quickly is your cash flow. It's really archaic, okay? I mean, you need to be able to manage your cash better than this, but it's just a general idea, okay? You're looking at your money in versus your money out, when it's going to hit versus each week. So on here you've got that plus your distributions, and it's going to have a rolling cash flow scenario. So once you kind of populate this and it gets you all the stuff that you're looking for, it's going to give you a cash dashboard, okay? And this will kind of help you map out where you're at, where your money's going to go, and what the flow's like. I doubt highly that your model's going to end up looking like this for real. So again, be honest with yourself, anticipate late payments and things like that, because it's the real world out there, right? So map this out so you make sure you don't run out of cash, and don't be pulling all your money out of your business. Keep your money in your business so that you don't screw yourself pretty much. So You'll know when the right time is to keep it. But for now, this is what I wanted to cover with you. I hope it's been helpful. I hope it's useful. But again, I think that the biggest driver on everything, all these reports basically come from your income statement. You got to know your numbers. You just got to know your numbers. And you can have it kick out these reports, these dashboards, however you like to see them, but make sure you at least have your pro forma done. You better have at least all this mapped out on what you're projecting your business to look like so you can start to make changes. The last thing you want to do is realize you have to make changes 4 months ago and now you have no time and now you've ran out of cash and you could have made some adjustments that might have been more difficult earlier but saved your business, right? It's just part of it, man. So I hope that this whole tool is useful. Just, I guess, reach out if you have any questions or need anything. Again, it's been a pleasure. Hope it helps. Bye.